Exercise 1.10. You are provided with information relating to Triline Limited for the financial year ending 28 February 2025. Required 1.10.1. Complete the statements of comprehensive income statement for the year ending 28 February 2025. 1.10.2. Prepare the following notes to the financial statement or statement of financial position. Ordinary share capital, retained earnings. Information 1, then they give you a list of balances, except for cost of sales and sundry expenses. Adjustments. A, goods are sold at a profit margin of 60% on cost price. The revenue of 6,170,000 Rand includes revenue of 150,000 Rand, on which trade discount of 20% was given to clients. B, inventory count on 28 February 2025 shows the following inventory. Trading inventory, 211,000 Rand. Packing material, 4,000. C, directors' fees for January and February 2025 are still owing to one of the directors. He has received 123,450 Rand up to date. There have been no changes to the monthly remuneration structure. D, the accountant calculated depreciation for the year as 62,100 Rand. However, she failed to write off depreciation on a new vehicle with a cost price of 220,000 Rand that was bought on 1 January 2025. Depreciation on vehicles is calculated at 12% on the book value. E, a debtor with an outstanding balance of 7,000 Rand had to be written off as irrecoverable. F, the provision for bad debts must be adjusted to 4% of the outstanding debtors. G, an employee who is on leave has been omitted from the salary journal for February 2025. His salary details are as follows. Net salary, 21,320 Rand. The total deductions amount to 18% of his gross salary. Employer contributions, 4,000 Rand. All employer contributions are also debited against the salaries account. H, outstanding interest in the fixed deposit must still be considered. The fixed deposit remained unchanged during the year and interest is not capitalized. I, rental income includes rent received for March and April 2025. The rental income increased from 1 September 2024 with 1,850 Rand per month. J, loan statement from ABSA on 28 February 2025 shows balance at the start of the financial year, 950,000 Rand. Repayments during the financial year, including interest, 144,000 Rand. Interest capitalized to be calculated, and balance at the end of the financial year, 853,500 Rand. K, income tax at 28% of the net profit for the financial year is 162,400 Rand. L, sundry expenses must be calculated as the balancing figure in the statement of comprehensive income or income statement. M, shares and dividends. The authorized ordinary share capital consists of 1.6 million ordinary shares, of which 60% were issued before 1 March 2024. Interim dividends of 6 cents per share were paid on 1 September 2024. During October 2024, a further 120,000 shares were in issue at 10.90 Rand each. It has been considered and already accounted for. On 28 February 2025, a final dividend of 3 cents per share was declared. On 28 February 2025, 280,000 shares were repurchased at 6.88 Rand per share. This transaction has not been recorded yet. These shareholders qualified for the final dividends. To start the income statement, we have to calculate the gross profit. To do that, we need to work out the revenue and the cost of sales. If we go to adjustment 1, goods are sold at a profit margin of 60% on cost price. The revenue of 1,170,000 Rand includes revenue of 150,000 Rand on which trade discount of 20% was given to clients. So to calculate the revenue, we are going to take the 6,170,000, and remember it's always your net revenue, and we are going to subtract the debtors allowances of 27,500 as from information 1. That then gives you a subtotal of 6,142,500 Rand. For the cost of sales, we need to take into consideration that we have a 60% markup as per adjustment A, and that 150,000 Rand of the revenue was a trade discount was given of 20%. So to work out our cost of sales, we're going to take the 150,000 Rand, we're going to times it by 100 and divide by 80. So 187,500 needs to be accounted for when we calculate the cost of sales. It has to be added back to our cost of sales. So our cost of sales, we take the 6,170,000 revenue, and we minus the 150,000 that was the trade discount of 20% to give you 6,020,000 Rand. So to calculate the correct cost of sales, it's going to be the 6,020,000 Rand plus the 187,500 of their trade discount not included, and we minus our debtors allowances of 27,500, and remember the markup is 60%, so we then times that amount by 100 divided by 160. So the cost of sales then amounts to 3,862,500 Rand. So the gross profit will be your revenue minus your cost of sales, and that gives you 2,280,000 Rand. The 3 operating income in this exercise will be bad debts recovered, provision for bad debts adjustment, and rental income. If we go to adjustment F, well, E and F will consider both adjustments. They say the provision for bad debts must be adjusted to 4% of the outstanding debtors. And in adjustment E, a debtor with an outstanding balance of 7,000 Rand had to be written off as irrecoverable. So if we go to information 1, our debtors control amount is 88,000. We are then going to minus the 7,000 that needs to be written off as irrecoverable, and we times that by 4%. So to adjust our provision for bad debts, the amount will be 3,240 Rand. But according to information 1, we provided 3,420 Rand. So thus a decrease of 180 Rand needs to be done. So we're going to have a provision for bad debts adjustment as part of your operating income. The calculation was 3,420 minus 3,240 Rand to give you 180 Rand. Rental income, we go to adjustment I. Rental income includes rent received for March and April 2025. The rental income increased from 1 September 2024 with 1,850 Rand per month. So if we do the calculation, 6 months was normal rental and 8 months was the increased amount because it included 2 months additional for March and April. So we're going to derive an equation where we have 6 months normal and 8 months with the increased amount. And that then gives us a total of 224,800 as per information 1 that we received for rental. Then if we calculate our X, it amounts to 15,000 Rand if we solve that equation. So our increased amount for March and April that we received as part of rent income is then 16,850 Rand. It's the 15,000 of our normal amount plus the 1,850 increased amount. We received that increased amount for 2 months, which is 33,700 Rand, and that obviously needs to be deducted from our rental income because it mustn't form part of our financial year as rental income. It was income received in advance. So 224,800 Rand minus 33,700 will then give you your correct rental income of 191,100 Rand. We will also consider the bad debts recovered, and that remained unchanged, 36,920 Rand. So our total other operating income, if we add those three incomes together, gives us a total of 228,200 Rand. If we add that to our gross profit, our gross operating income is then 2,508,200 Rand. To start with the operating expenses, we start with audit fees. That remained unchanged, 180,608. Salaries, we go to adjustment G. An employee who is on leave has been omitted from the salary journal for February 2025. His salary details are as follows. Net salary, 21,320 Rand. The total deductions amounts to 18% of his gross salary. The employee's contribution is 4,000. So we need to calculate his gross salary. So we take the net salary of 21,320 and they say it's 18%. The deductions is 18% of the gross salary. So 100 minus 18 is 82. So we take the net salary, we times by 100 and divide by 82. So we basically work backwards. So the total deductions will then be 4,680 Rand per month. So his gross will be his net plus the deductions to give you 26,000 Rand. And the employer's contribution is 4,000. So to work out the salaries that needs to be paid for the year, we go to information 1. Salaries paid so far was 594,000 Rand. We add the gross salary of the employee salary that was omitted, and then we add the 4,000, which is the employer's contribution. And that gives us a total of 624,000. Then we need to complete the director's fees. If we go to adjustment C, director's fees for January and February 2025 are still owing to one of the directors. He has received 123,450 Rand up to date. There have been no changes to the monthly remuneration structure. So the 123,450 Rand has only been received for 10 months. So we divide that amount by 10 and then we multiply it by 2 for the January and February amount that is still owing. So in other words, 24,690 Rand still needs to be added to the director's fees to be paid. So according to information 1, our director's fees is 567,870 Rand, and we now add the 24,690. Next is depreciation. If we go to adjustment D, the accountant calculated depreciation for the year as 62,100 Rand. However, she failed to write off depreciation on a new vehicle with a cost price of 220,000 Rand that was bought on 1 January 2025. Depreciation on vehicles is calculated at 12% on the book value. So if we take the 220,000 Rand cost price, we times it by 12%, and we had the vehicle for 2 months, 4,400 needs to be added. So depreciation according to information 1 is 62,100 that was paid, plus now the 4,400 to give me a total of 624,000. Packing material. From information 1, we paid 52,000, then we go to adjustment B. And adjustment B, we have 4,000 Rand of unused packing material, which we need to subtract. So the amount for packing material that needs to be paid is 48,000 Rand. Bad debts. Our opening balance is 8,900, and then if we go to adjustment E, a debtor with an outstanding balance of 7,000 Rand had to be written off as irrecoverable. So we'll add 7,000 Rand to our bad debts, and that then gives us a total of 15,900 Rand. Then trading stock deficit. Our opening balance for our trading stock is 217,000 from information 1, and our closing balance from adjustment 2, we have 211,000 Rand on hand, which we need to subtract. That then gives us a trading stock deficit of 6,000 Rand. Remember, the trading stock deficit expense is the amount of stock that the company cannot account for in the warehouse, and therefore it needs to be subtracted. To calculate the sundry expenses, it's going to be our balancing figure as stated in adjustment L. Income tax as per adjustment K. They state income tax at 28% of the net profit for the financial year is 162,400 Rand. So that will be the income tax that needs to be subtracted. If that's 28% of the net profit, then our net profit before tax will be our income tax times 100 divided by 28, and that will give you an amount of 580,000. Then to calculate the net profit after tax, we take the net profit before tax of 580,000 Rand, we minus our income tax of 162,400, and then we get an answer of 417,600. For interest expense, we will go to adjustment J. Our opening balance is 950,000 Rand at the beginning of the year. We minus our repayments made during the year, including the interest, and then we minus the closing balance of 853,500. So our interest expense to be paid is then 47,500 rand. You then work backwards to calculate your profit before interest expense. So the 580,000 rand plus the 47,500 will then give you an amount of 627,500. Interest income. We have a fixed deposit at Nedbank that yields 4.5%. Our fixed deposit from information 1 is 340,000 rand at 4.5% for the whole year, gives you interest income of 15,300. Again, the operating profit we work backwards to calculate. So we're going to take the 627,500, which is our profit before interest expense, and we are going to minus the 15,300. I mark the operating profit with a star so that the learners know it's a figure that was calculated working backwards, and the same for sundry expenses. We take the operating expenses amount of 1,896,000 rand and we subtract all the expenses we calculated to give you 362,432. Once again, I mark it with a star so that you know to work backwards and that it's a balancing figure. The operating expenses was calculated by taking the gross operating profit of 2,508,200 and then subtracting the operating profit of 612,200 to give you an amount of 1,896,000 rand. 1.10.2 Ordinary share capital. We first need to calculate what was our amount of shares in the beginning of the year. If we go to adjustment M, shares and dividends, the authorized ordinary share capital consists of 1.6 million ordinary shares, of which 60% were issued before 1 March 2024. So 60% of 1.6 million shares gives us 960,000 shares. During October 2024, a further 120,000 shares were issued at 10.90 Rand each. It has been considered and already accounted for. So 120,000 shares is issued during the year at 10.90 Rand per share, and that gives us 1,308,000. On 28 February 2025, 280,000 shares were repurchased at 6.88 Rand per share. This transaction has not yet been recorded. These shareholders qualified for the final dividends. So our number of ordinary shares that was bought back is 280,000 rand. Now we need to calculate the average share price because we buy it back at the average share price in the ordinary share capital account, and the difference goes to retained earnings. So our average share price, if we go to information 1, our ordinary share capital is 6,588,000 rand. We then divide by the 1,080,000 shares we have now up to that date to give me 6.10 Rand per share. So our average price is 6.10 Rand. If we multiply that by 280,000 shares that we've bought back, then we get an answer of 1,708,000 rand that we need to minus. So our shares at the end of the year, we're going to take 960,000, we're going to add 120,000, and we're going to minus the 280,000 shares that we bought back. This gives us 800,000 shares. If we times that by our average share price of 6.10 Rand, we then get an amount of 4,880,000 rand. Then if you work backwards, you get your shares in issue at the start of the year as 5,280,000 rand. Then lastly, we need to complete the retained earnings account. Our balance at the beginning of the year, if we go to information 1, is 113,022 rand. Then you need to study once again a format. You start with the net profit after tax, and according to the income statement, it was 417,600 rand. You also then have to account for the shares bought back, but remember, it's only the difference that goes to the retained earnings account. So it was bought back for 6.88 rand. Our average share price is 6.10 rand, so the difference is 78 cents. So 280,000 shares at 78 cents, we then subtract 218,400 rand. Ordinary share dividends, we have to go to adjustment M. Interim dividends of 6 cents per share were paid on 1 September 2024. So what is the amount of shares we had on that date? If we go back to our ordinary share capital account, we had 960,000 shares, and we are going to pay an interim dividend of 6 cents per share, and that gives us a total of 57,600 rand. Then on 28 February 2025, a final dividend of 3 cents per share was declared. The shares at the end of the year is 1,080,000 shares at 3 cents, and that gives us a total of 32,400 rand. So our ordinary share dividends to be subtracted will be 90,000. That is the 57,600, which is your interim dividends, plus your final dividends of 32,400 added together. So we minus the 90,000 rand at ordinary share dividends. So our balance at the end of the year on 28 February 2025 is 222,222 rand. And that is the end of exercise 1.10.